Bonjour tout le monde. Bienvenue à la Banque de Canada pour cette conférence de presse concernant notre annonce du taux directeur. Good morning, everyone. Welcome to the Bank of Canada and this morning's press conference about today's interest rate announcement. Governor Macklem will have some opening remarks, and then he and Senior Deputy Governor Rogers will be happy to take your questions until about 11:15. Le gouverneur Macklem va prononcer une déclaration préliminaire et ensuite on va tourner aux questions des médias. Alors, Monsieur le Gouverneur, à vous la parole.
Good morning, everyone. We're very pleased to be here together to discuss today's monetary policy decision. Today, the Governing Council maintained the policy interest rate at 2.25%. Since our April decision, the economic impact of the ongoing conflict in the Middle East has increased. Higher energy prices and disruptions in global supply chains are weighing on global growth and pushing up inflation worldwide. At the same time, the U.S. administration continues to propose new tariffs, and trade policy uncertainty remains elevated. Against this backdrop, the Canadian economy has remained soft and inflation has increased. Monetary policy continues to be focused on ensuring that higher energy prices do not turn into persistent inflation, while helping the economy adjust to headwinds. We are committed to keeping inflation low and stable over time. Le Conseil de direction a maintenu le taux directeur à 2,25%. Depuis notre décision d'avril, l'impact de l'économie du conflit au Moyen-Orient s'est amplifié. La hausse des prix de l'énergie et les perturbations des chaînes d'approvisionnement pèsent sur la croissance mondiale et font monter l'inflation. En même temps, l'administration américaine continue de proposer de nouveaux droits de douane et l'incertitude entourant les politiques commerciales demeure élevée. Dans ce contexte, l'économie canadienne est restée au ralenti et l'inflation a augmenté. L'objectif de la politique monétaire demeure le même. Empêcher que la hausse des prix de l'énergie se transforme en inflation persistante, tout en aidant l'économie à s'ajuster aux ventes contraires. Nous sommes déterminés à maintenir l'inflation à un niveau bas et stable au fil du temps. So let me expand on what we're seeing since the April Monetary Policy Report and the implications for monetary policy.
I know what they're not saying.
The conflict in the Middle East is slowing economic activity in the Gulf region and in many oil-importing countries, and sending inflation higher worldwide.
Especially
at the same time, AI-related investment is boosting growth in the United States and some Asian economies, and equity prices have been buoyant. In Canada, GDP edged down 0.1% in the first quarter, weaker than expected at the time of the April report. Consumer spending grew by 1.4%, but there was an unexpected pullback in government spending. Housing activity also declined, and business investment remained weak. While the labor market strengthened in May and the unemployment rate fell to 6.6%, there's been a lot of volatility in the monthly job numbers. When you look through the bumpiness, employment in Canada is little changed since the start of the year, and the unemployment rate has been fluctuating in the 6.5% to 7% range.
We can tell that by the
recent data suggests GDP growth will resume in the second quarter, with continued increases in consumer spending and more stability in the housing market. Even with some rebound in GDP growth, we expect the economy to remain in excess supply. As anticipated, CPI inflation rose in April, reaching 2.8%. The increase reflects energy prices, both higher global oil prices and the impact of the elimination of the Canadian consumer carbon tax falling out of the 12-month rate of inflation.
The tax until after
so far, there's been limited evidence of broad-based pass-through of higher energy prices to other consumer prices. Measures of core inflation have moved down to around 2%, and the share of CPI components growing above 3% is close to its historical average. Food price inflation moderated but remains high, and shelter inflation continued to slow.
Not just groceries.
With the conflict in the Middle East persisting, oil prices have remained elevated. Market expectations have shifted up since April, and oil prices are roughly $10 a barrel higher than we assumed in the MPR. Based on this, we expect CPI inflation to hover close to 3% in coming months before easing gradually towards 2%. We'll be watching closely for
he
evidence
talks about
of broadening in price pressures.
calm the labor market still seems.
The bank
even
is
though the
committed to keeping inflation
unemployment
close to the
dropped
2%
a few
target
tenths of
over
a
time.
percent. We're sitting here smiling with
At our
this
meeting this
huge
week,
bonus
we
checks
decided
they're
to
earning
maintain
for
the
hiring.
policy rate at 2.25%.
And the
Governing
employment
Council agreed to look through the
market.
war's near-term impact on inflation, but if energy prices stay high, we will not let their effects become broad-based, persistent inflation. Un ralentissement économique combiné à une montée de l'inflation pose
That's not
une
even a warning
dilemme
until
pour
September,
la
Labor
politique
Day.
monétaire. Si on augmente les taux pour freiner l'inflation, on risque d'affaiblir davantage l'économie. Et si on les baisse pour soutenir la croissance, on risque que
By then we'll be
l'inflation
so close
élevée
to
devienne persistante. Pour le
the
moment,
midterms, Trump will
maintenir
turn
le
those
taux
ships
directeur
around and they'll
inchargé permet
be getting
d'équilibrer
repaired in
ces
China, for
risques.
God's sakes, just to get them away from the
Cependant,
Middle East.
l'incertitude
They'll be
est
so
plus
desperate to
élevée
have
que d'habitude
something
et
happen
les risques pourraient
to
changer.
help them somewhere
Nous
in the
pourrions
midterm,
devoir
which
nous
is
ajuster
hopeless, but
rapidement. Si les États-Unis imposent d'autres restrictions commerciales importantes
something
au
is better than
Canada,
nothing.
nous pourrions
Would
devoir
you be thinking?
baisser davantage le taux directeur pour soutenir la croissance. Mais si le conflit au Moyen-Orient se poursuit et que la hausse des prix de l'énergie commence à se transformer en inflation
Look, I'm all
persistante
for
et
Mark Carney, and
généralisée,
I love the
la
Liberal
politique
Party,
monétaire
but I'm telling you right now,
devra
elbows up,
en
people
faire
are
plus.
fighting. We did not vote
Des hausses
for
consécutives
Carney
du taux
to
directeur
live in
pourraient
fear of
alors être
what the U.S. is
nécessaires.
doing.
Bien
We
sûr,
voted to
il y a
get
d'autres
stronger, and that's
scénarios
exactly
possibles.
what we're
Nous
doing.
restons prêts à réagir aux besoins
Things they got to
si
look
les
at are
perspectives
the
changent.
age gating of the internet and stuff like
Economic
that. They want
weakness
youth
combined with rising inflation is a
unemployment to
dilemma for
drop.
monetary policy.
They have got
Raising
to
rates to
stop
dampen inflation could
age
further
gating
slow the
things like the
economy.
internet. They have got to
Easing
start
rates to
letting
support
kids
growth
experience
increases
the
the
world
risk
as it is,
that higher
because that's how you
inflation
get
becomes
experience.
persistent.
That's how you become job
For
ready.
now,
That's how you become
holding
a
the policy
problem
rate
solver.
unchanged balances those risks.
Not by
However, uncertainty is unusually
blocking
elevated
and
and the risks could shift.
hiding them from the
Monetary
realities.
policy may need to be nimble.
You can't take
If
a
the United
kid
States
until
imposes
he's
significant
halfway
new
to
trade
middle
restrictions
age
on Canada,
and say you can't
we
have
may
any
need to cut the
experience
policy rate further
and then
to
just dump
support
him straight
economic
in.
growth.
Because
Alternatively,
37
if the
today is
conflict in the
middle
Middle East
age. If you
continues
hold them off
and
till
higher
they're
energy
15
prices
or
start
18
leading
years
to
old,
ongoing
we're
generalized
halfway
inflation,
to
monetary
middle
policy
age.
may
Just,
have more work to do.
they're
There may be a
thinking
need for
about
consecutive
what they're going to
increases
do
in the
for a
policy
retirement plan
rate.
at that point, if not sooner
Of course,
than
these
that.
are not the only possible
It's kind
scenarios.
of hard to plan for
The
retirement if
Canadian
you're not even
economy
allowed
is
to
working through a
experience the world.
period of structural change. Shifting trade relationships, the adoption of AI, and changes in demographics complicate the assessment of the economy. We're going to be watching all these developments closely and assessing their implications for growth and inflation. And as the outlook evolves, we stand ready to respond as needed. The bank is committed to ensuring that Canadians continue to have confidence in price stability through this period of global upheaval.
And that's what
And with that,
that's what Canada is
two of us
suffering
would be
from right
very
now.
pleased to take your questions.
Workforce.
Okay, thank you,
do the
Governor. We
jobs that
will
are
go to questions
available
now.
out
We'll
there.
start with the reporters who are here in Ottawa at the bank, and then we'll go to those who have joined us remotely. As usual, I'm going to ask you to please limit yourself to one question so that every media outlet has the chance to participate. If I forget to do so, please state your name and affiliation. Avant de poser votre question, veuillez vous identifier si j'ai l'oublié de le faire. Et comme d'habitude, libre à vous de poser vos questions dans la langue officielle de votre choix. So let's go to our first question here. I'm going to start with David Lundgren from Thomson Reuters, please.
Governor, good morning. You say you're going to look through the near-term impact of energy prices lifting overall inflation, but at what point do you stop looking through the near-term impact? Is it 1, 2, 3, 4 inflation prints in a row that you don't like, or suddenly the number spiking?
David, it's less about a timeline, and it's more about the conditions. So what are the things that we're going to be looking at? What we don't want to see is the big rise in energy prices turn into generalized inflation, and then we don't want that to become persistent inflation. So how do we assess generalized? I mean, right now we're not seeing, we're seeing very limited evidence of pass-through of higher energy prices to other goods and services, the prices of other goods and services. Obviously, you can see some effects. You're seeing, surcharges on airlines, for example. But broadly, you're not seeing much pass-through. How do we assess that? Well, core inflation, which strips out the increase in energy prices, it's actually ticked down. If you look at the proportion of CPI components that are rising faster than 3%, it's close to its historical average. So far, there's very limited evidence. But if we started to see more evidence that higher energy prices were passing through to other goods and services, that would certainly get our attention. That would be a source of concern. And then, yes, the other thing you look for is persistence. And there, things like looking at inflation expectations, naturally with higher inflation, near-term inflation expectations have gone up. Inflation has gone up. So of course, near-term inflation expectations have gone up. So far we're seeing longer-term, medium-term inflation expectations are remaining well anchored. But if you started to see those drifting up, that would be a sign that inflation is becoming entrenched and it's going to, the persistence is likely to go up. So those are really the things we're watching for. It's less about the timeline, it's more about the conditions.
Okay, let's go to Paul Vieira from the Wall Street Journal, please.
Good morning, Governor. U.S. inflation rose past 4%, according to data, at least this morning. Why do you expect inflation to be more muted here at around 3% in the coming months? Is it because the economy is that much weaker and there's more slack or spare capacity than originally believed?
Well, that's certainly part of it. I think, just to back up for a minute, I mean, part of it is that, we started with 2% inflation. Inflation until the war in the Middle East was running close to 2% for more than, roughly a year and a half. So we had inflation back to target. It has moved up, but it started lower. So it's still lower than the United States. There are some other factors pushing inflation up in the U.S. There's no question U.S. tariffs have boosted U.S. inflation. That effect is probably going to start to wane unless they take new trade actions. And as you said, as you mentioned, yes, the Canadian economy is soft, it's weak, and that tends to put a downward pressure on prices generally. As I said, we have not seen any evidence yet of broad-based pass-through of higher energy prices to other goods and services.
All right, next on the list I have Kevin Carmichael from The Logic, please.
Good morning. I'd like to try to get you to say a little bit more about what the GDP miss has done to the way you're thinking about the economy now and going forward. I mean, that was quite a big miss. Does that alter your estimate of slack in the economy, and therefore should we assume the normalization phase is going to be longer than we might have thought a few months ago?
Well, I'll dig in a little bit on the GDP number in a minute, but big picture, not a great deal really has changed since our last decision. The war in the Middle East is still ongoing. Uncertainty about U.S. trade policy remains. The review of CUSMA is ongoing. And the data overall there have not been big surprises. Yes, fourth quarter GDP was quite a bit weaker than we thought. But if you look under the hood, consumption grew 1.4%. You're still seeing consumer spending expanding. The miss was largely because there was an unexpected pullback in government spending. It can be difficult, translating. Government spending can be choppy one quarter to the next. We don't think there's any sort of ongoing shift in government spending. The government have announced their plans. We built those plans into our projection. Figuring out exactly how that plays out quarter to quarter is difficult. You look at Q1, so consumption was fairly healthy. Housing housing declined. Business investment was soft. And then, trade and inventories were largely a wash. That gave you, a very slightly negative quarter. We do think growth will resume in the second quarter. We expect to see expansion of consumer spending. We think there'll be a little more stability in the housing market, so it won't be subtracting from growth. So we do expect growth to resume. And if you look at the labor market, month to month, there's been a lot of volatility in employment. Last month was up strongly. If you look over the last 6 months, basically employment is roughly unchanged. The unemployment rate's been fluctuating in a range of 6.5% to 7%. So that hasn't really changed since last time.
Okay, we'll work our way across the room here. Now let's go to Craig Lord from the Canadian Press, please.
Good morning, governors. Thank you for taking our questions. I appreciate the details of the analysis of the Q1 GDP figures there. But given the conversations for the past 10 days, I do have to ask, do you believe Canada's in a recession right now?
Look, the short answer to that question is, based on the data we've seen to date, the economy is weak, but it is not clearly in recession. So let me just unpack that a bit for you. If you look at how the economy has evolved over the last year, GDP is roughly flat over the last 12 months. If you look at the labor market, it's up a little bit over the last 12 months, essentially flat over the last 6 months. As I mentioned, there's been a lot of volatility, month to month, quarter to quarter. But when you look through the bumps, the economy hasn't really grown in the last year, but it hasn't shrunk either. So, economists typically define a recession as a significant broad-based
more like a
decline
stagflation,
in
more like when
economic activity that lasts for
Reagan
more
took
than one
office
quarter.
just before
And
he
if you look
said
at the
tear
data
down
we've
that
got,
wall, and
as I
Iran
said,
released
based on the data we've
hostages.
got,
Right
based on that
after that,
definition,
boom,
the economy
massive
it's weak,
explosion in the
but
economy.
it's not clearly in recession.
And it
If you look at
rose
the first
10
quarter
times
was just barely negative
or more.
after the
And
decline
that's where we're at
in
now
the fourth
because we got
quarter
the
of
same
last
kind
year.
of change.
If
The
you
whole
look
world
across
is changing.
industries, what you
It's the
see
same
is
kind
that
of change
in the first quarter,
as when Reagan
more
was in
than
office.
half of industries
Cold
actually
War is not
grew,
ending,
expanded on a
but
year-over-year
it's a
basis.
change.
And as I mentioned, the unemployment rate's been
trade
relatively stable
is
in the 6.5% to
changing,
7% range.
the
So,
lead the U.S.
so
had is
far,
changing.
we have not seen a significant broad-based decline in economic activity. So,
We are due to see
I wouldn't,
explosive growth
recession is
in
not
Canada.
the word I would use. I would describe the economy as weak. It hasn't grown really in the last year. There's excess supply in the
By
economy.
fall, we're
There's
not
slack
going
in
to
the labor
recognize
market.
what
We're certainly
we had
assessing
in the
that
past.
closely, and as we indicated, we're prepared to respond as needed.
All right, call on Greg Quinn from
Keep in mind
Market
what
News,
Kearney
please.
promised was generational change.
Good morning.
It's going to take at least a decade.
In the
to
last
completely
decision, there was
change.
a reference to being able to keep the
More than
policy
one
rate
term.
about where it was if assumptions on oil prices and trade were met. I didn't see anything so explicit in this statement. Are you trying to tell us that it's becoming unlikely that the economy can get through this awkward phase on its own without some kind of change in monetary policy?
No, we were continuing to balance both risks we've described. The oil risk is one risk. If we see oil prices increase further, if we see them sustained at a very high rate, and most importantly, as the governor just described, if we see that start to feed into broader base price increases, that's a risk we'll need to react to. On the other hand, we still have this trade uncertainty overhang in the economy that could weigh on growth. We could get further trade action. We could get further deterioration from the sense of uncertainty we have. That's a risk we'd have to react to as well. What we're telling you today is we see those risks continue to be about where we saw them last time. The economy continues to be about where we thought it was last time, which means we've got the rate where we think it needs to be right now. We've got a forecast in a few more weeks, and we'll be taking all the data in and see where we're at then.
All right, next I'll go to Mark Rendell from the Globe and Mail, please.
So we have the upcoming review of the CUSMA USMCA, it seems like all three countries have said at this point they don't expect anything to be finalized on July 1. So we could be in a period of kind of extended uncertainty about the trade relationship. How are you guys thinking about that? Is that period of an extended uncertainty kind of the downside risk?
Trade relationship is over.
Cut rates. What could we look like if we don't get any kind of certainty in the coming month or two?
They can't do away with the free
Yes,
trade
as
because
you've
that's not
indicated,
how
I mean,
it
what
works.
what all
Congress would
parties
have
are
to
indicating is that,
do that.
this
But there's going to be no renewal.
discussions are
at this
ongoing,
rate. It's just gonna
negotiations
stay
are
the way it
ongoing.
was.
They're probably going to play out over a number of months. So yes, that uncertainty will continue to weigh on the economy. I think the good news
Problem
is
is not Canada. The problem is Trump has no plan.
with
He
the
doesn't
exception
want to
of the
govern. He
hard-hit
just wants
sectors,
to
the vast
make
majority of goods that are traded
tons
with
of
the United
money from
States
being
continue
in
to be
the
traded tariff-free.
presidency. He doesn't
I
want to
think,
do the governing.
businesses are starting to recognize that our trade relationship with the United States it's changed, and that uncertainty. It's even with the deal, I don't think you can be certain about anything. So businesses are having to adjust to that. You're seeing they're adjusting to that uncertainty. They are diversifying their trade. They're also to some extent just getting used to the new reality and getting on with business. If you look at our last business outlook survey, you could see that in the responses of businesses. Even though the uncertainty had gone away, they were starting to make investment plans. I'm not saying the uncertainty wasn't weighing on them, but they were starting to sort of recognize, okay, we can't just sit on our hands forever. This isn't going away. We've got a business to run. We've got to manage in an environment of uncertainty, and you're starting to see businesses get on with it. So we are expecting to see, at least in our last projection, as Senior Deputy Governor mentioned, it, we'll be updating that in our July projection, and we'll be getting a new business outlook survey as well. So we'll see how things are evolving. But I mean, based on the last one, we have some modest pickup in business investment going forward after a lot of weakness.
All right, I've got a couple more questions here in Ottawa. Let's go to Najoud Amalis from Bloomberg, please.
Good morning. I wanted to ask about the risk of higher energy prices feeding into generalized inflation. As you mentioned, core measures of inflation eased in April, but at the same time, you mentioned how oil prices are higher than the central bank was assuming in April. So I guess I'm wondering if you're more or less concerned today about that risk compared to April.
Well, look, I mean, the war in the Middle East is still going on. There's no clear resolution in sight. We don't know what that resolution would look like. There's been damage. So yes, this is probably, I mean, the fact that the energy price futures curve has shifted up, I think is reflecting that. And look, the longer this goes, the higher energy prices are, the longer they're higher, the bigger is the risk that starts to pass through to other goods and services. And, the more likely that becomes that then, we need to respond. So that is certainly a concern. And, we've been very clear, we're not going to let the war in the Middle East become an inflation problem here in Canada. But that's not the only thing going on. There is a lot going on. We've been talking about trade. Canadian economy is going through a period of restructuring, adoption of AI, lower population growth. So we got to look at all these things together, and we'll be updating our forecast and taking our decisions based on our assessment of where inflation's going, how the economy's doing.
Okay, and our final question here in the room is from Mackenzie Gray of Global, please.
There's two competing risks: the inflation risk, of course, and the trade concerns that you've talked about that could send monetary policy in two different directions. What do you view as the bigger risk to the Canadian economy?
Both is the short answer. That's the reason we're talking about both of them. Look, clearly, as I've just said, clearly, war in the Middle East it's ongoing. The longer it goes, the higher energy prices are, and in particular, the longer they stay high, that risks a one-off increase in energy prices becoming more persistent inflation. That's what we can't let happen. We're committed to getting inflation back to our 2% target over time. We're prepared to look through the near-term impacts, or what you might call the first-round impacts. But when you start to see second-round impacts, you start to see more persistent. That's certainly a signal that monetary policy has more work to do. But yes, look, trade remains very uncertain. The discussions, the negotiations remain ongoing. Hopefully that lands well, and the Canadian economy can, we can restore more certainty in our relationship with the United States. You can see, and I think if that happens, you'll see more strength in exports, more strength in investment. That'll be good to the economy. But look, we have no influence on that outcome. We're going to take things as they come. There are risks on both sides. They're both important.
Okay, we'll go to those reporters who have joined us remotely now. I'm just going to remind you folks on the line, come off mute only to ask your question, and then go back on mute as soon as you've finished so everyone can hear the response. I've got three folks on the line. First, I'm going to call on Anna Pereira from the Toronto Star. Go ahead, please, Anna.
Hi, good morning. Governor, you said several times that you expect growth to resume, but given your recent GDP miss, I have to ask, what is the evidence backing that belief? Are you expecting a resolution to the CUSMA negotiations anytime soon? Can you just give us some color on that?
So, look, our base case on CUSMA is that the negotiations continue to play out for a number of months. So we haven't built in a big change one way or the other there in terms of our outlook. In terms of what is the evidence for the second quarter, we do have some higher frequency indicators for the second quarter, which can give you some advanced perspective on where it may land. If you look at things, so there's a flash GDP estimate for StatsCan that was fairly positive for the first month of the quarter. We have some higher frequency data for consumption, for housing. Consumption so far looks like it's holding up, consumption growth, and housing, which did decline in the last quarter, looks like it's more stable. I don't think it's going to be a big contributor to growth based on the high frequency data we have so far. But based on that data, it looks like it's stabilizing, so shouldn't subtract from growth. Yes, look, I'll be the first one to admit that although we're actually well into the second quarter, we don't have that much data yet. There's always uncertainty. We've seen a lot of volatility in the month-to-month data, but when you look at our surveys, you look at the high frequency data we have, we do think the Canadian economy is poised to return to growth in the second quarter.
All right, now I'm going to call on Max Sato from Mace News. Go ahead, please, Max.
Hi, good morning, all. Thank you, Paul. Governor, my question is, this is not just for Canada, but many other countries. Energy and commodity prices remain elevated, and consumers in many industrial sectors are not receiving the full benefits of high energy prices, as you mentioned. And in Asia, shortages of naphtha and other materials are affecting the production of plastics and resins, which could lower the supply of appliances, vehicles, and medical equipment to other regions. So when this is happening, don't you think there's a need for governments to ask households and businesses to use less energy during the peak times and seasons to help central banks control inflation and mitigate its impact on economic growth?
Well, Max, that's not a decision the central bank makes. I mean, what you're describing is the risk we've been talking about in answer to other questions, which is the risk that that higher commodity prices start to spread into other goods and services. If that happens, our job is to deal with the inflationary impacts. Direction on how to conserve energy is well outside our mandate.
Okay.
Governor, you don't have any answer?
No, I think we'll move on. Our final question is from Rob McClister of Mortgage Logic News. Go ahead, please, Rob.
Good morning. At historical monthly rates of change, the average of median and trim inflation would take several months to get back above 3%, which is the control ceiling. Would that be your expectation, assuming oil prices stayed in the $90 plus range? And if so, would you need to see average core inflation near or above 3% to seriously think about imminent tightening?
Well, first of all, let me clarify how we think about the 1% to 3% range. First of all, the range, our target is for total CPI inflation, and the range, it is the 2% midpoint of a 1% to 3% range. You shouldn't think of the range as sort of hard, a hard boundary. You should think of the range really more as a way to try to help explain to people what is kind of the normal variation in inflation. So, I mean, if you look over history, at least pre-COVID, total CPI inflation was within the 1% to 3% range 80% of the time. Obviously, we have a 2% target. We can't literally hit 2% every month, but 80% of the time it's bouncing around in the 1% to 3% range. And I think as long as it's in that range, well, it's a pretty normal state of affairs. Occasionally, there are big shocks that can push it outside of the range. And it's on us to explain, okay, why is it outside of the range, and what are we going to do to get it back into the range? So we use core inflation really more, especially in this context, as a tool to help us understand how generalized price increases are. If the only reason inflation goes up is because of one price, higher oil prices, higher gasoline prices, or a small number of prices related to energy, that's more of a relative price shock, and it's not really inflation. So it tends to be something we would look through, where we tend to look through the first round effects, particularly when there's some weakness in the economy, which reduces the risk that it's going to get passed through to other goods and services. If we start to see core inflation drift up, because it is, higher energy prices are spreading, that is certainly something that would get our attention, because that would suggest that CPI inflation is not going to come down to the target. And we might have to take some action to get it to come down to the target. So I hope that helps you think about the role of the band.
Okay, and that will conclude today's press conference. Thank you.
All right, so there you have it. We'll see you later. Don't forget to leave your comments in the comment area, like, follow, and subscribe, and we shall be back. Bye-bye.